Joining me now is Greg Halter, Director of Research at the Carnegie Investment Council. So good to have you on with us, and want to get your take on the latest ADP number, which points to maybe a weaker than expected jobs market that's really been holding in pretty strong.
Yes, thank you for having me. The number today definitely was less than anticipated, and actually we've had a slow creep, if you want to call it that, upward in terms of the Thursday claims that come out, both the initial and the continuing. So, it's not been as robust as you may seem, certainly not horrible, but not booming either.
Well, based on the first 2 minutes of trading, though, Greg, this is a market that seems to want to move higher despite the fact that the data points to a weakening jobs market, and despite the fact that we still don't have any trade deals. So what does that tell you about where the market goes from here?
Very interesting. The markets will do what the markets do. I will point out that the Vanguard, the VOO, which is an S&P 500 fund, has taken in $62 billion plus this year. All those dollars have to go into the market. That's what an ETF does. And hence, they're buying the names that we all know and love. And that just kind of keeps things going. I will say that the retail side of things really stood in there very strong in April. And the retail actually turned out to be the smarter investors, if you want to look at it that way, in terms of just riding through that dip we had earlier in the year.
Well, we just had the Dutch Bros CEO in the studio with us, and we know that consumers continue to buy their coffees at Dutch Bros. That stock has seen this impressive run higher. But we know oftentimes that the consumer spends because their job situation is good. So how concerning is it that the latest data could be pointing to some weakness?
Sure, there's certainly lots of stories about the consumer and some of the past due data in terms of credit cards and loans and so forth. Dollar Tree had a warning today, and then on the other hand, you had Thor Industries, which makes RVs. You certainly can't have a much more consumer discretionary item than that, and I think the stock was slated to be up 12% this morning as they came in better than anticipated. So as always, there's these cross currents, and again, Thor on one side and Dollar Tree on the other. It's an interesting disparity, if you will, between dollar items and something that can cost $100,000 for an RV.
So tell us, Greg, what areas of the market look attractive to you given the gains that we've already seen? I mentioned the S&P 500 being up about almost 2% year to date, but it's more than 20% off the low. So given the fundamentals and given valuations, what do you like?
Sure, valuations are starting to get up there, but we're really not sector investors at Carnegie Investor Council. We're looking for specific names. Some of the companies we like currently continue to be Progressive Insurance, Chubb, Kinsale, some of the utilities like NextEra and Alliant. Continue to like Google and Amazon in the large cap space. So there's always things to buy out there. It's just a matter of doing the fundamental research and be willing to own these companies for the long term.
I know you said you're not sector investors, but you do like a few names in big tech, so I have to ask you about big tech. Do you expect that to regain its market leadership position, or is it going to be very name specific?
I think it'll be name specific. I believe I saw something yesterday that the Mag 7 is the lowest it's been in 5 years or something in terms of percent weight. That's because other parts of the market have rebounded and done fairly well here recently.
All right, Greg Halter, Director of Research at the Carnegie Investment Council. Thank you so much for your picks and your insights.
Thank you for having me.